just real statistically significant outperformance in some names and some sectors versus others, and that kind of gives some insight.
We'll hit it a little later, Joe, but we actually had a big trade on our sector rotation model powered by NASDAQ Dorsey Wright. So we'll save that nugget for like minute 37 to keep people enticed.
Because they might be dropping off by 32, right?
That's right. You never know.
That's right. All right. But let's kick it off with a little bit of look at the technicals. So I am going to share my screen right now. And as you can see, I've got the S&P 500 up today. Well, it's been an interesting day, Jeff, in the overall broad market. I always kind of want to start with that 30,000 foot view in the S&P and what we got right here. You can see all the chicken scratches here on my chart, but basically what I'm showing is we're having, lower highs. We're consolidating kind of in this, 3,000 to 31 or 3180 level. We held the 3145, which I thought was pretty important because that was a level that we had a hard time getting up above. We did trade below it today, but it looks like at least heading into those last, 50 minutes of trading or so that level is holding at this point. We've held the 20-day moving average. We've bounced off that. Really just kind of vacillating, I guess, if you will, in a bit of a tight range. And Jeff, my question to you is this the new normal? Because, we went from a market that was, moving a couple percentage points a day to now, even though we did have a decent range today, I think at one point S&P was down about 50 points. It does seem like it's found a bit of a new range. Or should we be looking at this as kind of a range-bound market for the next few months, maybe all the way up until the election? Or, in your opinion, do you think earnings could shake things up a bit?
Well, I think it's really interesting, and we are seeing some consolidation. And I think the consolidation is actually quite constructive, Joe. And we're seeing the consolidation here on the chart. You bring up a great point, that 20-day moving average. It's rising slightly as we continue to go and knock on the earnings season door. But what I see is look at today. Today's a perfect example of a 65 handle range. That 65 handle range is nearly 2%. And maybe the VIX is properly pricing in the realized move of the S&P 500. But I think it's encouraging to see, and I think this is just healthy. This is a healthy-looking chart, and I think healthy-looking charts continue to grind higher. So unless we have some really bad data coming out or some curveball and additional coronavirus fatalities, which we have not seen, despite the fact that we've seen additional testing, additional reporting of cases, the fatality number, that data has actually been diminishing. So we get excited about that. But I think this allows the market to grind higher, and maybe we have a short-term test of those February 19th highs.
So what are we trading off of then? Because you brought up a good point. I got to be honest with you. Out here in the Bay Area, in California, we had initially, we were much more. I want to say we're a little earlier than everybody else in the lockdown. We held out a little bit longer than everybody else in the lockdown, and it seemed like things were going well. And then, now we are becoming more and more of an epicenter of some of the new cases out here. So, I keep an eye on that, but it does seem like the market is trading off of, the not just the cases, the surging cases, but as you mentioned, the deaths. What else do you think this market is trading off of? Is it hope for more stimulus? And what are some of the keys that you think investors should be paying attention to?
Well, Joe, to be clear, I'm in Chicago, and we're still locked down. I'm strapped, in a jacket right now to my desk, and we haven't been able to do much here in Chicago. We're in phase 4. I can't keep track of what phase we're going into next, but nonetheless, it has been challenging here, and that's been the biggest challenge, I think, for active investors, for portfolio managers, to try and figure out the fits and starts, the local, state and local economies reopening, shutting down, and that's been a very hard measurement here domestically and also challenging globally. But when we talk about what we think is really moving the market, I think it's the acute response, the swift response of the Federal Reserve and Treasury. Let's not neglect Treasury, but the Federal Reserve, they were so quick to act. That money has to find a home. And it's funny, I was on CNBC talking about this earlier this week. Maybe the NASDAQ 100, maybe some of these giant cap names like the Microsoft, like the Apples, like the Amazon, maybe some of these names have become a safe haven, Joe. It's hard and almost comical to say, but it's interesting to see how these assets continue to get attracted. And it seems like the market, every time it has the ability to go down, and even the NASDAQ today, the NASDAQ was down earlier to give you an opportunity to try and buy it, 100 handles lower. But boom, you blink your eye and it's back up. So you continue to see assets. And I think that undercurrent, that's one thing that's really important. And I think it's a great takeaway is that whatever we're doing here from the Federal Reserve, from the $3 trillion that came in, most likely at minimum, another $1 trillion coming in the market. But what is that providing? That's providing a template. Lock and step, you're going to see other global central bankers mirror or shadow Federal Reserve Fed Chairman Powell in the same manner that we saw a lot of the global central bankers mimic and shadow Bernanke back in the crisis. So I think this additional stimulus, it has to go somewhere. It typically finds its way back into the domestic market, and it sure does love technology.
That's a really good point, because I think that we get caught up in this idea that it's just our central bank that's flooding the market with liquidity. But if all the central banks are doing it around the world, then it is a rising tide to a certain extent, and that money's got to go somewhere. We've kind of beat this dead horse to a certain extent, where Liz and I have kind of talked about the money supply versus the velocity of the money, and where's it going? Is it making its way through the economy at this point? And to the up until a couple weeks ago, it hadn't really been doing so, right? You have net savers right now with consumers; they're not going out there spending, and part of the issue is they're kind of locked down in their homes. But as more and more of these restrictions start to come off, but once again, we'll see if that continues. You are seeing retail sales start to pop a little bit. You are seeing the consumer discretionary names start to do well. Costco basically hit it out of the park yesterday by saying that it was 11% year-over-year same-store sales. I don't think anybody was expecting that. I think expectations were for around 4 or 5%. So, the consumer is still doing this part. Maybe they're switching a little bit in terms of where they're buying things. It's not. It's clearly not at Walgreens as they're having issues right now, or CVS. But it's become a new economy, and it's become a new way of doing things. And I think that kind of brings up this conversation of a secular change, and maybe maybe that's the case, why the NASDAQ is doing so well, because of some of the semi names and what we're seeing there. What are your thoughts on that?
No, it's a great point. And we talk about the new normal, the new economy, and I think that is really relevant. I don't think the economy, I don't think you can own Zoom forever, right? I think some of these names, which are going to be more trend like, but I do think you're going to go back to finding some of these names which will prevail. So if it's an NVIDIA, if it's an Intel, if it's a Microsoft, I look at Amazon. We talk about Amazon a lot, vaulted over $3,000 earlier this week. That's a big deal on Amazon. But my thumb is sore, Joe. My thumb is sore. And why is it sore? From hitting the Amazon app. We're overusing Amazon, and that's going to obviously take away from other names. But you look at some of these names, and that's why we're seeing such a concentration, such a flow of assets in there. And I remember I was on CNBC Christmas Eve. It was 2018, and that's when we had that big volatile episode in Amazon. We went under $1,400, and people were laughing that I was had Amazon on my shopping list. That was $1,400. Now we're above $3,000. So Amazon is a name that I think is going to continue to win in this new economy. But you're absolutely right to bring up the semiconductors. If you look at the broader swath ETF, SOXX, that has all the big boys in there: Qualcomm, NVIDIA, Texas Instrument, Broadcom, Intel. These are all names that we know and love. But if you have conviction on a certain name, God bless, and that's the way to go. But if you're looking for more diversification and to equal out your exposure, I think some of these ETFs do make sense, Joe.
That's a good point. And I got I actually got a great question that just came in from our viewers.
I'm not sure if I have a great answer, but let's go for it.
No. You'll be able to answer this one. This is from Dave in Oregon, and he says, "Can you have Jeff clarify what handles means?" So here you go. You have an opportunity now to go back to your days of yore and explain to our audience what a handle is.
All right. So great question from Oregon. Thank you, Dave. But we're going to go back to yesteryear. I spent a lot of time. I cut my teeth in the pits in Chicago. And when you talk about a handle, that's a point. So in the S&P 500, if it's currently, let's look, where is the SPOOs? And SPOOs is another term we used to utilize for S&P. So stick with me on the jargon. But right now, the S&P is down 14 points or 14 handles. So that's just a floor jargon. We have a lot of other things that we would talk about, Joe, but that's one of the cleanest ones we could talk about. Is a handle is equivalent to a point.
That's right. I think that's where we got to stop. Yeah.
Yep,
All right.
we went whoop back on the road. We almost won the ditch there, Joe.
Yeah, exactly, exactly right. And you know what? I think sometimes we forget that not everybody speaks in the same type of dialect that we do. So it is helpful. So yes, a handle, and the nice thing about that, Jeff, is it translates to pretty much any type of product, doesn't it? Whether it's fixed
Yeah,
income, whether it's
for sure, for sure. The
equities,
Nasdaq, but then when we talk Treasury market, you would talk in ticks. So there's
Mhm.
32 ticks in a 10-year note or a 30-year bond, and it actually trades in half ticks. But there's 32 full ticks. One full point is 32 ticks, and the way they derive that is that every one contract in the 10-year note, it's $1,000 when you go a full point. So that's the math worked backwards. But maybe we'll save a little something for the next closing markets, Joe.
Yeah, yeah, I think people's heads are going to explode here pretty soon. So I guess we should move on. Let's take a look at maybe some of the underperforming sectors out there. I'm going to start with the XLF. Boy, financials, Jeff, you tell me, is this ship going to get turned around anytime soon, or are we just kind of locked in this, hey, rates aren't moving until 2022, so, hold off? I mean, is that what we're looking at here?
Well, it seems that way. And if you look at Wells Fargo is the poster child for not owning financials, right? And I know they're in the midst of a turnaround. They were in the midst of a turnaround prior to COVID-19 hitting the markets. But I think when you look at XLF, the broader swath, what's interesting, there's just a ton of emotion in the tape. And one of the things that we utilize at KCAM is we really rely on the technicals. We use the point and figure analysis, try to be 100% systematic, and we have not owned financials. We actually sold financials on March 25th, Joe. So our systems weekly screen to see if there's any type of relative strength, and that's really important in our sector rotation theme. It's to stay with sectors revealing strength and stay the heck away from sectors revealing weakness. So on March 25th, we sold financials and then buying biotech, and that's worked out well. But the financials right now, look at that chart. That is ugly.
So when you guys do biotech, is it more the BBH, IBB, or what are you guys looking at?
So we use IBB, but yeah, you can use a variety of XBI, whatever your exposure
Mhm.
is. But IBB is the exposure we utilize, and IBB's been really interesting. And it's funny, some of the names in here you wouldn't think would be participating in the upside. There's a name like Horizon Therapeutics. They have nothing to do with COVID-19, right? But a lot of these names in here, of course, you have the Amgen, Regeneron, Gilead. You have all these names that you hear about every day, looking for vaccines, looking for treatments for coronavirus COVID-19. But high tide lifts all boats, Joe. And when you see this global sense of urgency into biotech, we've never seen a global sense of urgency into biotech like this before. We've had SARS, we've had a variety of different diseases, but we've never seen this type of interest. So even if you want to take peel back the onion a little bit more, healthcare by and large, XLV. XLV is another name where you're going to see more and more interest. So those are two names, biotech and healthcare, that are both in our sector rotation, taking up about 25% of our exposure. So those are two sectors that we really want to have exposure to, not just for Q2, Q3, Q4 of 2020. This is going to be a recurring theme. I think the way we live our lives personally and our work lives is really going to be dramatically changing. There's going to be such a focus on healthcare as well as some type of biotechnology as an undercurrent. This is a new normal, and I think this is going to be a lasting effect. I don't think we walk away from the importance of health.
You guys added option positions in that portfolio, or is that just a long equity or a long ETF?
That is a long only ETF. Some of the bespoke work we do with some of our financial advisors and family office
Mhm.
clients, we will do a variety of different risk mitigation, covered call strategies, try to produce income. But it's very interesting to see, covered call strategies help mitigate risk to the downside. But if you don't know what you're doing, writing calls, you're going to miss this whole move up. And I think the S&P is up,
That's right.
about 48% off that March 23rd low. So you
Mhm.
have to be very, very understanding. I know you guys do a great job at Schwab explaining how to utilize, and it is certainly a piece of the puzzle. We love having an options in our toolbox, but you have to understand how to use it because it is a power tool, and it can leave a mark if you don't use it properly.
Yeah, that makes a lot of sense, and I know that a lot of money managers will incorporate option strategies for clients who have a concentration of wealth in a certain name. It could be you could utilize something like a collar strategy. You could utilize a covered call type strategy, but I think it's
Yes.
it's important to understand. And one of the things that the professionals help you do is they help you kind of manage some of that risk around those option positions, because as you mentioned, those are never kind of set and forget it strategies, are they?
No, no. And if you're looking at like a risk reversal after such a move higher, we'd be selling a call on that underlying and buying a put lower, potentially protecting that downside if we do have some type of pullback here. You just have to understand what it's just critical. And this is, options 101, which you're great at, Joe, but it's understanding, is it a credit spread or is it a debit spread? Are you collecting premium or are you spending money? And it's okay to spend money. Some people just want to write and collect premium, but it's okay to spend money for risk mitigation protection, but you have to understand and define. And that's the beauty of using options. You can define your risk. And just like when you pay your insurance man every year for your house, if your house doesn't burn down at the end of the year, you don't call them up and scream at them. But if it helps you sleep at night after this type of move, having some type of risk mitigation, either at a zero cost collar or if it's a small debit or even a credit, I think you really have to slice and dice and understand your exposure, your strikes, and what all that works. But it's great to have the ability to use options on these ETFs or these single stock names.
Wait till you start paying the earthquake insurance and seeing whether or not you start screaming about that.
Well, that means I'd have to
Then you
move
will.
to California, so I don't know if that's happening anytime soon here. I don't think Governor Pritzker is letting us out of Illinois. We're not allowed to leave, supposedly.
That's right. That's right. All right. Well, I want to take a look at the TNX, because next week, I mean, we talked about this. You were talking about Wells Fargo. They come out with earnings next week, but it's really the kickoff of the earnings season for July, and the banks are always the first ones to go. So we're gonna have Goldman, we're gonna have Bank of America, we're gonna have J.P. Morgan, Citigroup, all reporting next week, and one major source of revenue for a bunch of them. And here, guys, I absolutely would recommend this as you start going through and paying attention during the earnings season. Really look at that net interest income component of their revenues, because here we start to see, every time we've kind of gotten a little bit of a rally here in the 10-year, it started to fade back. And here we go, back again today. We're kind of at the low point of the day, down 7%, which takes us to 60 basis points. So, definitely less than 1% for the next 10 years. And remember, one of the ways banks make their money is they borrow short and lend long. But what happens when interest rates are this low is that it makes it difficult to make that money on that spread.
Well, I think you
When you
bring up a
look at
great point, Joe, and I think you'll be interested to see. A lot of the S&P 500 companies have removed forward guidance, and I get it. So
Mhm.
analysts are going to be really challenged, but inside of this challenge, I think there's opportunity. So I look at a name like J.P. Morgan. J.P. Morgan. If I'm going to own a bank, you're going to put me to it, Joe. I want to own J.P. Morgan. I
Mhm.
think they do business right, and they have the opportunity there. Of course, we're going to be focused on net interest margin. But one thing that you don't really account for when you see volatile episodes like this, and we do not see volatility like this. We saw, the VIX above 80, it's still, tethered to 30. So there may be some type of surpassed expectation of what they made in trading. These banks really do a great job of trading in volatile environments. So that could be a surprise, the upside for a JP Morgan. But I think broader swath, if you look at XLF, yeah, I mean, we don't want to own it yet, but if you're a stock picker and you want to potentially even utilize upside options, you could have a call spread in here in some of these names where you could participate if the market does move. And I think the volatility expectations coming in this earnings season, they are elevated. And it's elevated for a reason, because there's just so much uncertainty. No matter any analyst, what they tell you, they're going to try and measure and gauge. I think it's really hard to measure this upcoming earnings season. And typically, the financials give us a little bit of a insight of what's to come, but I think they're their own animal this earnings season. Joe, what do you think?
I would agree. A couple things that I'm going to be paying attention to, and once again, I brought up this little research box. You can just literally, guys, you can just right click right within the Street Smart Edge graph here. You don't even have to go to Schwab.com. You can bring up the research right here. But a couple of things I think you want to be paying attention to, as we mentioned, the net interest income component. I absolutely going to want to be listening to what the banks have to say in terms of what they're holding in reserves, because that was a big component of the
Great point.
last earnings. Is they talked about adding extra reserves for potential defaults. So are they continuing to hold those in reserves? Are they starting to open up a little bit more in terms of liquidity? Are they using that money to go out and lend? Because that was one of the things that I really noticed in the last earnings call when when the CFOs and CEOs were announcing. what they're doing with that money, they're absolutely holding it a little closer to the vest than they were before. A couple of other things I want to be paying attention to, maybe some of these ratios. Whether it's PEs, earnings per share. One of the things that I like when I'm looking at something in the financial sector is a price to book value. And when you start to get to the area where the price to book or price to tangible book, if you will, you want to start taking out some of that goodwill, right? Here's your price to tangible book. Anytime you're sub one, in the financial sector, that's usually considered, getting to the area where you might start to see some value investors maybe start to step in a little bit. And it's, look, it's not a recommendation. You guys can do this through any of these different financial names. I just happen to bring up Bank of America right there, but a couple of you had mentioned JP Morgan, so you can do the exact same thing as you're kind of going through here and just seeing, okay, well, what's the price to book on that one? What's the price to tangible book, and so on and so forth. And as you'll see, some look a little bit cheaper than the others, but hey, you got to remember, that's not the end of the analysis, right, Jeff? I mean, you can't just say, here's the one thing I'm looking at. You also need to think about, especially in this market. I mean, Jeff, one of the things that I've noticed in this market, and interested to hear your take on this, is that, boy, any of the kind of the value metrics that maybe we've looked at in the past, it seems to be out the window right now, doesn't it?
No, that's accurate. Absolutely accurate. And I think one of the things that we talk about, and if we look at the different sizes of companies that will be evaluating this earnings season, certainly, we know the giant caps, the large caps, the mid caps, small caps. Small caps, they basically got hit the hardest in this COVID, right? Because of the uncertainty. So one of the overarching themes I think should be in your analysis is the essential component. Is this company really essential to the U.S. economy? And moreover, will it be in existence in a year or two? And I think that's going to be critical to pricing power. And these companies and the pricing power that they have in a year or two is going to be so relevant in how the stock market reacts and how investors embrace them. And they're going to overpunish the ones that potentially are on the cusp, but they're also going to celebrate, like the Amazons and Microsoft and Apple. So there's definitely a bifurcation there, but that's one of the things I think you need to input into your analysis of stocks you want to know, because this is going to become a stock pickers market. I think it has for the last couple of months. It's been a sector tilting market. And I think if you become a little bit more dynamic, a little more tactical in your exposure, that's how you produce alpha in volatile times. I think it's time to embrace the volatility, not hide underneath your desk.
Agreed. And I think that brings me to my next point. There's a question that just came out this is Joel in Texas. He says, hey, Jeff, what are your thoughts on the sectors and volatility as we head into the election in November? And one of the things you brought up just right now, Jeff, was this idea that, kind of looking at these secular trends and pricing power. And boy, I continue to look at real estate, and I just look at it and I say, okay, even though what we're seeing from the consumer real estate market and the home builders just showing just massive strength, I wonder if you're in the commercial real estate space, what do you do? Do you have any pricing pressure at this point, or are you just are you looking at your contracts over the next 10 years and saying this could get a bit dicey?
I think if you're in commercial real estate, you're grabbing rosary beads right now, Joe, to be honest with you. But I think to kind of, the focus, we definitely see home construction just surging. The suburbs, houses aren't lasting long. Inventories are going lower. They're lifting offers, where in the tier one cities, New York, Chicago, San Francisco, I think it's going to be challenging. But to kind of get to Joel's question, Joel, we didn't forget about you. But I think when we see this election period, it's going to be fascinating to see. And for the first time, I think in a long time, healthcare is not going to get beat up. And if you rewind 4 years ago, when Hillary Clinton was in the lead or whatever poll you're looking at, healthcare really got punished. And all of a sudden that turned around. But healthcare has really got a foundation here going in. But the one, let's talk about a couple other sectors, but industrials. We talk about industrials and we can dissect it into the 14 different subsectors. But these industrials, we're calling this the catch-up trade. And some of these bigger names, these essential names like a Boeing, wildly volatile, right? Understatement of 2020. But some of these names inside the industrials, I think you're going to want to own, because will they be in business in 2 years? Will they have pricing power? And then if I also look at the screen here, we talk about utilities. Utilities is fascinating to us, and we've owned utilities for over 3 years in our sector rotation model.
I don't think anyone's ever once said utilities are fascinating, but I'll let you run with that one. Go ahead.
But hang in there. I'm going to bring it home here for Joel in Texas. So utility's been fascinating. If you look at a 3-year chart, let's pull it up here as long as we got.
Sure.
Pull up XLU and the S&P 500 on a 3-year chart. If you ever look that up until COVID-19, XLU and S&P 500 have been pretty darn, shadowing each other, just absolutely following each other, lock in step. And now all of a sudden you've seen in our ETF model portfolios, which are powered by technicals, we sold utilities in Q2. So for the first time, we've exited this position. And what does that mean in layman's terms? That means that our models are looking for more beta. Utilities is a lower beta, safer way to have exposure. And now all of a sudden, we're seeing a higher beta play by not having exposure to utilities. And lastly, a trade that we made today, we're not quite at minute 37, Joe, but I'm going to let the cat out of the bag. The trade we made today in our sector rotation, we sold energy. And that's been a fascinating trade. It's still down on the year, the worst sector in the S&P 500, but we bought it in the middle of April, XLE, and we bought that and sold it today. For whatever reason, I'll give you the reason, the technical levels and the relative strength, we've seen maybe the time to harvest gains and take those profits. So with crude oil tethered to $40, we could see some consolidation as we really have an opaque view of what the demand of crude oil is globally, specifically out of China. But energy and utilities are a couple of sectors that we've recently sold. But it's going to be great to see the volatility surrounding some of these subsectors as we get closer. And yes, I think Joel's right. The election is just a couple of months away, and no one's really put enough importance on that.
So let's go back to options for a second.
Let's do it.
One of the things that has been kind of a story throughout the course of the year as we look at the VIX, and the VIX has held. I mean, look. The VIX has held, it's not 80, right? But it's held a pretty volatile level, right around 30. I mean, it's basically held
double than it was in 2019. Yeah, it's more than double than the average 2019. Absolutely.
So it's held this 200-day moving average. It's basically trading around 30 now, and it's been doing that now for, a couple of weeks or so. Even a month, let's say a month. My thought is that it's going to continue to hold that bid all the way really through until we get closer and closer to the election, because there's just way too much going on in the world right now, and it's interesting because you see the markets going up as much as they are, and let me go ahead and do that same overlay on here that I did with the sector ETFs that we mentioned. Take a look at the SPX here, and usually these kind of move in different directions. Let me get all this stuff.
Yeah, historically speaking, they're inversely related. Exactly.
Right. But look at this. As we've been seeing kind of the S&P come back off its lows, yes, we have seen the VIX come down, of course, from its highs. But the S&P continues to still rally, and the VIX is still holding some of this strength. And my hypothesis is that, look, if you're, while we did break 30, and maybe that is kind of our new median, maybe that's the new area we kind of gravitate towards. This is not like it was before, where that was a ceiling. This might be the floor for a bit, and we might be trading around this level. And what we've seen through some of the option traders out there is they've really started to embrace this idea of buying that protection out around the November and December contracts, whether that's in the VIX or whether that's using the SPX, trying to hedge some of that election risk. So volatility is probably here to stay, isn't it?
I think it is. I think we're in a completely different volatility regime. We call that a volatility regime, which is simply just a different range. So this range that we're in right now is predicated on the fact that we do have some uncertainty just in the election. You put in the coronavirus, you put in a vaccine, you talk about rhetoric potentially with China. They're talking about moving TikTok out of Beijing. All these different pieces of the puzzle, Joe, they do put a bit in the option
without TikTok.
I had to bring in TikTok. It took me some time to work it in. We had to talk about TikTok. I have 3 kids under the age of 14 for crying out loud. But when we talk about the option premiums that people are willing to pay, that is what the VIX is calculated off. It's what people are willing to pay. And when you see this type of velocity like you brought up earlier, we're going to see people continue to have some type of, they're going to fall on the side of being protected. And why? I think it's truly a function of the fact that not too many people had protection out of the month of March. we saw that move. It was the fastest 35% drop in the history of the S&P 500. February 19th, the high, to March 23rd, the low. I think a lot of people were underprotected. We saw a lot of people selling to the hole. So here, all of a sudden, the market's recovered, it's stabilized. A lot of people are skeptical that the stock market is ahead of where the actual economies are reopening. But nonetheless, I think this moment in time, people are saying, you know what, fool me once, shame on you, fool me twice, shame on me. So that's why I think you're seeing a lot of bids in the option market that's keeping the VIX tethered to 30.
Yeah. No, that
Tick
makes, I
tock.
mean,
Tick tock.
are you doing a TikTok dance as we speak right now?
It could be. I could be. You never
I
know.
got I gotta say, I'm gonna get off track here for a second, and I'm gonna go in the ditch. And this is just my own little personal aside. And I'm pulling into we went to a little vacation last weekend where we rented one of those tiny houses, Jeff. We rented a tiny house
Nice.
up at Dillon Beach over here in the Bay Area. And as we pulled into the parking lot for this little tiny house resort area, there was a family doing a TikTok dance right in front of the water, right in front of the gate,
No
to get into
way.
the area. And all I'm thinking of is, could you please move because I want you to put masks on as I'm trying to walk past you to get to my tiny house as this family is doing their TikTok dance. So there we go.
Oh,
That's my
there it
aside.
is. There it is. TikTok come full circle. Yeah, that's amazing. I think yeah, it could have been a TikTok of you watching them TikTok. That would have been epic.
That's right. That's right. Okay. All right, back on track. Good question here from Juan in Florida. It says, "Hey Jeff, you mentioned that the XLU and XLE were some of the things you divested from the portfolio. But is there anything that you're looking to that you added recently or looking to add?"
No, great question. And we did buy. This is an interesting one, and I think a lot of people are going to kind of scratch their head because we sold energy. But what did we buy recently? About a month ago, we bought the IGE. That's the North American Natural Resources. But don't be overwhelmed by the name of it. These are names you know. This is by and large Chevron, Exxon, Newmont, has some Barrick Gold in there, ConocoPhillips. So a different way to approach energy is this ETF IGE. So that was one purchase we made. And then before that, April 22nd, we did buy healthcare. And healthcare continues to be a theme that we continue to see lighten up our matrices. So there's a couple nuances there, but I think the natural resources, similar to the way we own energy for just about 2 months, I think there is some short-term movements in there, and they're all exuding relative strength, and that's why we own them.
Well, and this is interesting too, because when I look at the holdings in here, you mentioned Chevron and Exxon, and I immediately thought about the XLE, but take a look at the difference here. You've got basically 19% of the portfolio tied up in these two names, which might seem like a lot, but look at the XLE when you bring that one up, and now you're talking 45 to 46% of the
That's
XLE is
right.
really tied up in those
But
two
when
names.
people
So
hear North American natural resources, they get a little adverse to what are we doing here.
yeah.
But I think it's interesting to understand what's at your disposal. And another one, which lit up on our tactical model. So we run a couple different models powered by NASDAQ diversity, right? But look at IEO. That's the U.S. oil and gas exploration and production. And these are names that you typically don't talk about from a broader swath ETF. But if you look at some of the holdings, these are names that we all know, Joe. Again, you see ConocoPhillips taking a big weight, Phillips 66, but you also have a Valero. You
Mhm.
have a lot of different, it's a broad swath of exposure to the different opportunities inside of the patch. And certainly we saw oil by and large get beat up, and there's going to be some defaults that people don't recover. But as you're seeing rig counts drop, as you're seeing more rhetoric come out, and eventually some type of demand come out globally, I think a lot of these names are going to prevail. And, there's names in here like Apache, there's names like Devon, names that
Mhm.
you typically don't own, but you can't own them in a broader swath ETF, which kind of mitigates some risk. But it's getting
Yeah.
crushed today, no doubt about it.
Well, and I wasn't purposely, sorry, I wasn't trying to purposely bring that one up to show that.
It's
I
okay to
was
wear
actually
me out. I'm okay. We're in 37 minutes deep. I'm comfortable.
what I was actually looking at is I was checking to see if there's any options on it, because when I looked at that, one of the things that came to mind is that kind of gravitating around the $30 area, and there's not a lot of
No,
liquidity in this, so
there's
then that.
not. There's not a ton of AUM in this. But if you're trying to get a broader swath, these markets are still tight. But the options, there's a little challenge in the market option for sure.
Yeah, yeah. Yep, makes sense. Makes sense. Yeah, no, I was looking at maybe some potential put sells as a way to kind of maybe enter this position somewhere between the 30 and the 25s if you can dollar cost average. Hard part is there's just not a lot of liquidity there, so you don't get the tight bid-ask spreads as you normally would. But
For sure. For
yeah,
sure.
thank you for answering that
One
question.
other ETF, we'll bring up IHI. This is kind of a,
Hmm.
when we talk about healthcare, we talk about a variety of different biotech. This is medical devices, and every press conference I hear, it's talking about hospitals needing this, factories needing this. So these medical devices, I think, has become bigger and bigger. And this has been an interesting holding of ours. We've owned this for quite some time, and we still continue to own it for a reason. So I think this is another healthcare kind of conversation, and IHI has been interesting.
It is interesting. I'm looking to see. I want to see some of the holdings in here as well too. I
Yeah,
don't know if
Abbott
you knew this,
Labs.
but I grew up in the great city of Kalamazoo, Michigan, home of Stryker, and I was getting curious to see if that
And I
was one
think
of the holdings.
Striker's in there. I think Zimmer's in
There
there
it
as
is.
well. Yeah.
It is.
Kalamazoo, Western Michigan. My nephew
Western.
is going to play football there if they allow to play football. He's going to be a freshman year for the Broncos. So
Very
go
good.
Ryan. Yeah.
Home of Greg Jennings. I don't know if you remember that name, but Greg Jennings is a former Bronco. He had a pretty darn good career. So good for your nephew.
Yeah, it'll be interesting. They
There's
actually
some
play my
interesting
Fighting
holdings.
Irish this season. So, all right, I'll stop talking football. That's for another show, Joe.
I could do that all day, you know that. Yeah, I'm curious as to see kind of where that's going to go. The Ivy League, right? They canceled all fall sports, and you can say what you want. People say, okay, it's the Ivy League, but remember the Ivy League. Everybody was the first one to cancel basketball in March before everybody else kind of jumped on
That's
that
right. And
on
what's
that train as well.
interesting, since I'm not affiliated with Schwab, I can actually say whatever I want to say, right? As long as I don't go in the
Of
ditch.
course.
But it is interesting to see there was a political undercurrent that they canceled the season, and at the same time Harvard sued the administration.
Right.
So I try to dance between the raindrops, but understand there's a political component here in some of these reasons and coming out. But I do think the Ivy League, which is one double A, it's fantastic. I'm not diminishing by anything. I don't think that's the moneymaker that the SEC is or the Big Ten. So I think we're
Yep.
going to see football to a certain extent, but we're going to have to be mindful of what those protocols are. And I'm not getting into a political conversation. I just want to see some structure go back, and I hope that these athletes, men and women, have the ability to play college athletics.
I do too, and we're all hoping for kind of return to normal. Yeah, Big Ten generates $1 billion a year in annual revenues from sports, so I'm assuming they're going to do what they can to see if they can get
That's right.
those
That's right.
guys in the field. Speaking of politics, we won't dive deep into politics, but I do think we have to talk about this for a couple minutes here while we kind of wrap up because the market did really move off this, and that is really that Supreme Court decision. So Supreme Court's been busy
Yes.
this week. They've been
They
busy this
have.
week. They sure have. And today, basically, they, they announced that presidential financial records, can be made available. But hold on, everybody. Let's break this down eventually because I've heard misinformation about this all day. So I was listening to a radio show this morning. It came out and made it seem like everything's out in the open. Then they kind of retracted a little bit. So I want to make sure you guys get the correct information. And this is according to the Associated Press. So in the case involving Congress, so this is the, opening up the book, so to speak, to the House of Representatives, the Supreme Court's 7-2 ruling returns the case to the lower courts. And so basically that means it's heading back down to lower courts. They'll make the decision. It's unclear how quickly that case might be resolved. So what does that mean? That means that there's little to no chance that the records will be released to the public soon, and almost zero chance that that'll happen prior to the November election. Now, in the New York case, this is with the Southern New York district. Also a 7-2 ruling, excuse me, but the court rejected the broad arguments by the defense team and the Justice Department that the president is immune from investigation while he holds office. Which, I mean, Jeff, that goes way beyond tax records. That's kind of a big statement, isn't it?
It is, and I think there's going to be some reverberations, and I think this just brings the whole political conversation, which is going to be happening this November. I think it brings to the forefront. So I think we're going to see continued fireworks, even though we didn't even see fireworks here in Chicago. I think we're going to see fireworks in the wake of this, and I think this is going to politicize the market and all the emotion undercurrents that we see going into every 4 years when we have to elect or re-elect the president.
Yeah. So that there could be reverberations from that decision for years to come. A couple other things to point out today on the economic calendar. We had initial jobless claims continue to moderate, but they did remain above the 1 million mark. These are things that I watch every week. With the weekly initial jobless claims, they did come in at 1,314,000 for the week ended July 4th, but that was below the estimate of 1.375. The 4-week moving average fell by 63,000 jobs to 1,437,250. Now, continuing claims for the weekend of June 27th, they fell by about 700,000 to 18 million, and that was below the estimates of 18.8 million. So that's good. 4-week moving average continues to drop 636,000 to 19 million. And last but not least, May wholesale inventories. They were unrevised at 1.2% month over month drop in line with expectations, and that was compared to April's unadjusted 0.2% gain. Now, Jeff, you're a former bond guy. What are some of the economic headlines that you think our viewers should be paying attention to, just in general, not necessarily this week, but I mean, we all know unemployment, of course, but what are some of the other ones that maybe maybe it's not on their radar, but probably should be?
Well, I always like to look at PMI. I think the Purchasing Manager Index gives you an idea, and that can be broken off into regions, but it gives you at least a look at what is actually going on today in the economy. And that's the biggest thing is when we see these state and local economies reopen and all these different companies are reopen, if it's restaurants, if it's hospitality, if it's leisure, that PMI, it does kind of feed into that, and that could be a decent indicator. Of course, we're looking at the jobs data because the jobs data is what the Fed's looking at. There's so many moving parts there, and there's gonna be so many, misestimates, I should say. So I think you have to keep an eye on that. But bigger picture, I think we have to understand that we're going into earnings season. There's going to be some volatility here. There's going to be some hiccups. Some people are going to be over punished. Some people are over celebrated. But if you have the ability to, harvest some gains or to add some potential losers you have conviction on, I think this earnings season is going to offer that opportunity.
That's a good point. I just want to show on the calendar next week what earnings is going to look like. So basically, really kind of kicking off here on the 14th. And so before the opening, you got JP Morgan, Citigroup, Wells Fargo, Delta Airlines, and then it's like I said, we talked about financials for the whole week. So that will be what everybody's paying attention to. You got United Health Group in there as well too. They've that stock's been a beast as of.
Yeah, we fortunately have owned that. That's been a nice holding. Need to see if that continues to have some momentum on the upside for sure.
Oh man, we call that a soft phone in the business. All right, Jeff.
We also own the airlines. So full disclosure, we pick on award. We've owned American Airlines, so there it evens it out.
So then you need that United Health if that happens,
That's right.
All right, man. It was fun as always. Just want to let you guys know that's not it for the day. So coming up after Jeff and I finish with our little collaboration here, we got Start Trading on Street Smart Central with Katie Johnson and Kevin Grain. They will wrap up the day for Schwab Live Daily. So, Jeff, buddy, I appreciate your help as always, man. Good talking to you.
Hey, Joe, you're the best. Thanks for having me, pal.
And I appreciate all of you joining us as well. Unfortunately, it looks like we might be kind of heading back down a little bit towards some of those lows here. Let's see if we hold that 31.45. We got another 14 minutes to go. But as always, appreciate what you guys do when you tune in, and I appreciate being clients of Schwab. You guys have a great day. Goodbye.
Dividend yield is a ratio and one of several measures that helps investors understand how much return they're getting on their investment. For companies